Okay, let's unpack this. You know how there are some essential pieces of infrastructure in the world, the things that are absolutely critical, fundamental, but often kind of hidden.
Yeah, totally. Like the power grid or, I don't know, the pipes under a city. You don't notice them until something goes wrong.
Exactly. And the global financial system, well, it has players just like that. Today, we're taking a deep dive into one of those, MSCI Inc.
MSCI. Right, they're kind of behind the scenes, but they build so much of the essential architecture for global investing.
The maps, the rules, the measurement tools, basically. They don't manage your money directly, but they provide the benchmarks, the data.
The software that asset managers everywhere rely on to figure out where to invest, how investments are doing, managing risk, all of that.
And this deep dive, it's not just us talking theory. It's built specifically for you, our listener, based on that stack of analysis, research, your notes you shared.
Yeah, you want to get under the hood, right? Understand MSCI's business quality, its financial strength, what the future might hold.
So, our mission today is simple. Go through your sources with you, pull out the key insights, and basically give you a shortcut to being really well informed on MSCI.
Think of us as co-navigators, sorting through this material alongside you.
Okay, so let's start right at the beginning. What does MSCI actually do? The sources describe it as like the central nervous system for global investment.
That's a good way to put it. They're fundamental. They create and license indexes, like the famous MSCI World Index.
Right, everyone knows that one.
And trillions, literally trillions of dollars in investment products are based on these indexes. It's like they created a universal language for investors.
A common language, yeah. One source called it a toll road for global capital flows. That feels pretty apt.
It does, yeah. A toll road. So how do they collect that toll?
Okay, how do they make money? Seems like there are two main ways based on the material.
Exactly. Two main engines. First up is recurring subscriptions. This is the bedrock. Stable, high-margin stuff.
So the client's financial institutions paying regular fees.
Yep. Annual fees, often multi-year contracts, to use MSCI indexes, get their data feeds, use their software for risk management, portfolio analytics, that kind of thing.
Essential tools they need day to day.
Absolutely essential. Mm-hmm. And these contracts, they often have, built-in price increases each year, small bumps, but consistent.
And that adds up. How big is this piece?
In their last fiscal year, 2024, it was over $2.1 billion in revenue just from these subscriptions across all their segments. Predictable, high margin.
Okay, $2.1 billion, that's a solid base. What's the second engine?
That's the asset-based fees, or ABF. This is where that toll road idea really kicks in.
Okay.
MSCI gets a small percentage, a fee, based on the total assets under management in track AUM in investment products that track an MSCI index. Think ETFs, mostly.
So as more money flows into, say, an ETF tracking the MSCI World Index.
MSCI's revenue from that ABF stream goes up automatically.
And how much money are we talking about here? How much is actually benchmarked to their indexes?
The number is, it's pretty staggering. As of June 2024, the sources say $16.5 trillion in assets were benchmarked to MSCI indexes globally.
16.5 trillion. Wow. That's hard to picture.
It really is. And specifically within their index segment, those asset-based fees brought in over $657 million in revenue in fiscal 24.
So this part of the business lets them ride some big waves, right?
Exactly. Two huge long-term waves. One is just the overall growth of global capital markets over time. The other is that massive ongoing shift towards passive investing using index funds and ETFs. More money goes passive, more money likely tracks MSCI, more ABF revenue.
So it seems really simple at its core. Provide the standards, the tools everyone needs, then get paid through these sticky subscriptions and fees that grow with the market. Built to last, it sounds like.
It really does feel that way. I mean, The need for trusted benchmarks, for measuring performance, fulfilling fiduciary duty is not going away. It's fundamental.
And the sources really emphasize it's not just stable, it's actually being pushed forward by these big long-term trends.
Absolutely. That global shift into passive investing, that just funnels more AUM their way. Then there's the growing demand for more specific indexes, factor indexes like quality or value. People want different slices of the market.
And the big one everyone talks about now, ESG.
ESG, exactly. Right. Environmental, social, governance, and climate considerations, too. As investors increasingly integrate these factors, they need data, they need tools, they need indexes built around them. That's driving significant new demand specifically for MSCI's products in those areas.
Yeah.
Strong tailwinds.
And all this momentum, it feeds into what the sources call a flywheel effect. Can you break that down?
Yeah, the flywheel. Think about this. MSCI spends decades, right, building its brand, its reputation, trust, credibility, like those 50-plus years mentioned.
Okay, building the foundation.
That draws in clients. They start using the indexes, the data. Then, as more and more assets get benchmarked, like that $16.5 trillion figure,
their indexes become the standard.
they become the standard language. Exactly. And because they are the standard, other firms kind of feel they have to use them too for comparisons because their clients expect it.
It reinforces itself.
Totally. It cements their position. That generates lots of high-margin revenue, which they then plow back into the business. Better data, new analytics, expanding into new things like ESG or private assets data.
Making the platform even better.
Making it more valuable, more integrated, which then attracts more clients, grows the AUM further, and the whole cycle speeds up. Success breeds success. It's powerful.
Okay, so a powerful business model, riding trends, fueled by this flywheel. But what stops someone else from just coming along and doing the same thing? This is where that economic moat idea comes in, right?
Right, the moat, the defenses. And the sources say MSCI has a formidable trifecta, 3 layers.
The trifecta? Okay, what are they?
First, intangible assets. Think their brand name, decades old, synonymous with global index. Then there's their secret sauce, their proprietary index methods. And crucially, that huge historical data set they've built over 50 years. Try replicating that from scratch. Very hard, very expensive.
Right, history and reputation aren't easy to copy. What's layer 2?
High switching costs. This one's huge. MSCI stuff isn't just, software you use casually. It gets deeply woven into how their clients operate.
How so?
It's embedded in their core workflows, building portfolios, measuring risk, compliance checks, reporting to their clients. It's all tied in. So ripping MSCI out and plugging in something else.
Sounds like a nightmare.
Immense complexity, huge cost, massive disruption, retraining staff, technical integration headaches, explaining to your own clients why the benchmark changed. It's a major risk most firms just don't want to take.
Okay, major hassle factor. And the third part of the trifecta.
Network effects. This ties the first two together. Basically, the more people use MSCI, the more valuable it becomes for everyone.
How does that work?
Well, if trillions are benchmarked to MSCI and all your competitors use it for comparison and your clients expect reports based on it, you almost have to use it too, right? To be speaking the same language. It creates this feedback loop that makes MSCI the default choice.
And the sources give a really specific example of this with BlackRock's Aladdin platform.
Yes, that's a perfect case study. Aladdin is this massive investment management system BlackRock uses internally, but they also license it out to thousands of other institutions globally.
Okay, widely used system.
And MSCI's data and analytics risk, ESG, climate, all that, it's integrated directly into Aladdin's core functions. So if your whole operation runs on Aladdin, trying to ditch MSCI would basically break key parts of your main system.
Wow, so the switching cost there is astronomical.
Practically prohibitive. It shows how those switching costs and network effects really lock clients in, especially through these big integrated platforms and partnerships.
So it's not just a moat. The sources argue it's actually getting wider. What's the evidence for that?
Good evidence, both numbers and qualitative stuff. Quantitatively, just look at their client retention rate.
How good is it?
It's consistently amazing, like 93% to 95% range. The sources mentioned a recent figure, Q1 2025, of 95.3%. That's phenomenal stickiness. It tells you clients find it incredibly hard or undesirable to leave. Those switching costs are real.
95% retention. Yeah, that speaks volumes.
Definitely. And qualitatively, think about their strategy. They keep expanding into related areas, ESG, climate, private assets data. These aren't just new revenue streams. They make the whole platform more integrated, more essential, raising those switching costs even higher.
Embedding themselves deeper.
Exactly.
Yeah.
And just look at the AUM growth from $13.7 trillion benchmarks a few years back to $16.5 trillion now. Clear sign the network effect is getting stronger, pulling more assets into its orbit.
And this widening moat, it's not just defensive, is it? It gives them some offensive power, too.
It absolutely does. That high retention, that indispensability, it translates directly into pricing power.
They can charge more.
They can. And they do. They consistently roll out annual price increases on their subscriptions year after year, and clients largely accept it because, well, what choice do they have? They need the product. Minimal churn.
So pricing power plus.
Plus the fact that it's a capital-light business. They don't need billions for factories or inventory. This combination, pricing power, low capital needs, generates what one source called a torrent of free cash flow.
A torrent? Sounds like a good problem to have.
A very good problem. And it gives management huge flexibility for allocating that cash, reinvesting, buying other companies, or giving it back to shareholders.
Okay, amazing business. Strong defenses. Now, the sources you shared also gave us a peek behind the curtain views from customers and employees. What did that reveal?
Yeah, this part was interesting, kind of a tale of two cities.
Okay, let's start with the customers. What's the feeling there based on the material?
Well, it's probably not love in the way you think about, say, a consumer brand. It's more like deep, maybe even grudging respect, indispensability. Investors just view MSCI indexes, like MSCI World, as the default, the standard, the accepted common language for global stocks. They might argue about which fund tracking MSCI is best, but the index itself, its legitimacy as the benchmark, is rarely questioned.
So less, I love this product, and more, I absolutely need this tool.
Precisely. It's essential infrastructure. Like, you don't love the highway system, but you absolutely rely on it. For a B2B provider of critical plumbing like MSCI, that kind of deep-seated indispensability is maybe the most powerful validation you can get.
Got it. Okay, so customers see it as essential. What about the employees? The sources suggested a different story there.
Yeah, definitely more of a mixed bag internally, according to the feedback cited. On the plus side, compensation and benefits seem pretty good. Top tier, maybe top 50% versus peers, the note suggested, implying it's competitive.
Okay, good pay is a positive.
And they get recognized as a top company in places like India, and there seems to be encouragement for learning, internal mobility. Those are real positives. But there are clear negatives highlighted too. Overall leadership only gets a C grade from employees in the feedback mentioned. And maybe more concerning, the Employee Net Promoter Score, ENPS.
Yeah, how likely are employees to recommend working there?
It's negative, -10. Anything below 0 means you have more detractors, unhappy employees than promoters. The source material said almost half were detractors. That's not great.
What were the main complaints?
Anonymous reviews pointed to issues with manager quality, retention, suggesting people might be leaving, and a feeling of being undervalued for the amount of work they do.
Wow, that's a stark contrast between the external business strength and this internal picture.
It really is. And the sources make a crucial point about this. MSCI's incredibly strong moat seems to be insulating its amazing financial results from these internal cultural weaknesses, at least for now.
Meaning a weaker company couldn't get away with this?
Probably not. Internal friction would likely impact performance much faster. But for MSCI, the moat buys them time. Still, from a long-term investor perspective, looking at the materials you shared, this is definitely something you'd want to monitor. A persistently weak culture could eventually start to erode things, execution, innovation, maybe even the moat itself over a very long time.
That's a really important nuance. The engine might be powerful, but the crew needs to be functioning well too. Okay, speaking of keeping the engine running, let's talk leadership and financial stability.
Yeah, crucial stuff. Because even the best business can stumble with bad stewardship or a shaky foundation. But here, the picture in the sources looks largely positive.
Let's start with leadership. Henry Fernandez, the CEO, he's been there forever, right?
Remarkable tenure, yeah. Since the mid-90s. Guided out of Morgan Stanley, took it public in 2007. And reading his comments, his letters, there's this consistent theme. Long-term view, thinking like an owner.
How so?
He talks a lot about positioning MSCI for big structural trends, reglobalization, index investing, calls it an all-weather franchise, focusing on the next evolution. Seems very forward-looking.
And didn't a well-known investor, Ron Barron, have high praise for him in the notes?
He did. The sources quote Barron calling Fernandez incredibly driven, talented person, and saying his dedication to shareholders is second to none. That's a pretty strong endorsement from a respected long-term investor.
Okay, strong leadership perception. What about how they've actually managed the company's money? Capital allocation?
The sources basically call it a masterclass. Remember, it's a capital-light business. They don't need tons of cash for factories or machines.
Right, investment is more about people and tech.
Exactly. So reinvestment needs are relatively modest compared to the cash pouring in. When they do M&A, acquisitions, it's disciplined.
How so? Bolt-on acquisitions.
Yeah, smaller strategic buys that add capabilities or data to strengthen the core. Think Barra for risk analytics, Real Capital Analytics for real estate data, Burgess for private assets. They enhance the moat, push into adjacent areas. It's not about building a giant empire through risky mega deals.
Smart, focused deals. Okay, so careful reinvestment, smart M&A.
Yeah.
What about giving cash back to shareholders?
This is where the Masterclass label really seems to fit, based on the numbers you shared. Between 2012 and 2024, they bought back a massive $6.6 billion of their own stock.
$6.6 billion, how many shares is that?
Over 50 million shares taken off the market. And here's the kicker, the key detail from your material. They bought them back at an average price of around $129.78 per share.
Wow. Compared to where the stock is now, that's created huge value.
Enormous tangible value for long-term holders. And they kept at it, spending $810 million on buybacks in 2024 alone, while also consistently raising the dividend. Really looks like management acting in the best interest of owners.
Okay, that definitely paints a picture of shareholder-friendly management. Now, the financials themselves. Does that torrent of free cash flow show up?
Oh, absolutely. The sources nail it, calling MSCI an exceptional earnings machine. Get this. Revenue growth every single year for over a decade.
Every year. That's rare.
Very rare. From $1.7 billion in 2020 up to $2.86 billion in 2024. And it's incredibly profitable growth. Operating margins consistently over 50%, adjusted EBITDA margins around 60%.
50% plus operating margins consistently.
And the index segment. The crown jewel, its adjusted EBITDA margin in 2024 was an unbelievable 76.6%. That's the profile of a dominant business with serious pricing power.
Those margins are incredible. What about those specific quality ratios the sources pulled out? ROIC.
Return on invested capital, ROIC.
Right.
Exceptional and even improving. Consistently above 20%, hitting 32.4% in 2024. That's a classic sign of a superior business deploying capital really effectively into high return opportunities.
High returns on capital, check. What else?
Free cash flow conversion. FCF&I. Basically, how much of their reported profit turns into actual cash. MSCI is a lead here. Consistently 100% or even higher. It was 125% in 2024. It means earnings are super high quality, backed by real cash, great working capital management.
So the cash generation is definitely real. What about debt? Any concerns there?
Their net debt to adjusted EBITDA is around 2.4 times. The sources say that's well within their target range, easily manageable given how predictable their cash flows are. They use debt efficiently but prudently.
Okay. Now, one thing in the notes that might make someone pause. Negative stockholders' equity. That sounds bad.
Right. That's super important to clarify. Yes. GAAP stockholders' equity was negative $940 million in 2024. And normally, negative equity is a huge red flag sign of distress, maybe insolvency.
But not here.
Not really, no. The sources explain it's mostly a mathematical artifact from that massive successful share buyback program we just talked about.
Because they spent so much cash buying back stock, it reduced the equity account on the balance sheet.
Exactly. They spent billions retiring shares, often at prices much lower than today's value. Doing that so aggressively over years eventually pushed the book value of equity negative. But the key, again, is that their return on invested capital, which includes both debt and equity in the calculation, is still exceptionally high, over 30%.
So it's not distress, it's actually a sign of aggressive capital return.
It signals a highly efficient capital structure. They're using low-cost debt smartly and returning basically all excess profit to owners via buybacks, optimizing value rather than just letting equity pile up on the balance sheet. It's sophisticated, not dangerous in this specific context.
Okay, that makes a lot more sense. Phew. So, fantastic business, fortress moat, elite financials, aligned management. Truly sounds like a wonderful company. Which brings us, inevitably, to the big question. What about the price?
The price. That's the crux of the debate, isn't it? As of mid-2025, looking at the numbers you provided, the valuation is, well, it's up there.
How high? What are the metrics saying?
Trailing price to earnings, PE ratio, is around 37.2x. Price to free cash flow, PFCF, is roughly 31.0x using current market cap and that FY24 free cash flow number.
And how does that stack up historically for MSCI?
It's actually moderated a bit. That PE around 37x is below its recent 3-year average of maybe 41x and definitely below the 5-year average, closer to 48x. So more reasonable than it has been at times.
More reasonable, but still pretty expensive compared to the average stock.
Oh, definitely. A significant premium to the overall market. The sources are clear. Unequivocally, a wonderful company. Fortress moat, elite returns. But companies like this, they rarely trade cheap.
So the current valuation is demanding.
Demanding, yes. Suggests the market fully gets the quality story. Buying here means you're betting heavily on continued strong growth to justify that price.
Not much room for error, then. Little margin of safety, as the notes put it.
Exactly. It's framed less as finding a bargain, more as maybe getting quality at a fair price. You acknowledge the quality, but accept you're paying a premium for it.
So what are the growth engines you're betting on if you buy today? What needs to keep firing?
The sources point squarely back to those big interconnected secular trends. One, the ongoing global shift to passive index-based investing. Two, the structural integration of ESG and climate factors into investment decisions.
And MSCI is positioned to benefit from both.
Uniquely positioned, really. They provide the essential picks and shovels, the indexes, the data, the tools for both megatrends. More money goes passive. Good for MSCI. More mandates require ESG. Good for MSCI.
And we saw the ESG segment growth numbers earlier. That engine seems to be working already.
Yeah, that climbed from $111 million in 2020 to $327 million in 2024 in ESG revenue shows that part is definitely contributing significant growth right now.
Okay, but every investment has risks. What could permanently damage the story? What are those big long-term impairment risks the sources identify?
Two main ones stand out in the material, things that could really challenge the core thesis long-term. First is geopolitical weaponization. As the global index provider, MSCI gets caught in the middle of international tensions. That U.S. House Committee investigation in 2023, looking into their inclusion of certain Chinese companies, that's a prime example cited.
And the risk there is if they're forced to make political calls.
Exactly. If governments pressure them into making politically motivated decisions, who's in, who's out, based on politics, not markets, it could shatter their brand. Their whole value proposition rests on being an objective, neutral, market-based standard setter. Lose that neutrality, you damage the core intangible asset, the trust. It's seen as a serious, maybe growing threat.
Credibility is key. Makes sense. What's the second major risk?
ESG credibility collapse. ESG is a huge growth driver, right? But the whole ESG ratings world faces intense scrutiny.
Subjectivity, changing methods.
Right. Criticisms about subjectivity, methodology shifting, potential conflicts of interest. The sources even mentioned reports alleging biases, like potential anti-Israel bias in some ratings, fueling these concerns.
So the risk is that the ESG engine itself could just fall apart.
Or get severely damaged, yeah. Imagine a big greenwashing scandal involving their ratings.
Wow.
Or a successful lawsuit challenging the validity of their methods. Or maybe tough new regulations come in that basically standardize and commoditize ESG ratings.
Turning it from a high-growth, high-margin business into something less attractive.
Exactly. It could permanently impair that growth engine, slow the company down, and likely lead to the market putting a much lower valuation multiple on the stock.
Okay, great business, premium price, clear growth drivers, but also these distinct, serious risks.
Got it. Now let's try that second-level thinking the sources talked about. What's the market consensus and what might it be missing?
Well, the standard view, the consensus, seems to be pretty much what we've just laid out. MSCI, phenomenal business, wide moat, but yeah, it's expensive.
And analyst ratings reflect that. Moderate buy, maybe?
Generally, yeah. Moderate buy ratings, price targets suggesting maybe modest upside. The market clearly sees the quality and durability, but it's cautious. Wary of the valuation, aware of those risks, especially around ESG. So if there's a contrarian angle, it's not saying the market is wrong about the quality, but maybe focused on the wrong thing.
That's the potential nuance the sources suggest might be getting overlooked. The market is maybe so focused on the fast-growing ESG piece and its associated risks that it's underestimating the sheer grinding durability and long-term pricing power of the core index business.
The original engine. Which
Yeah.
is still the biggest part, right?
Still over half the revenue, probably an even bigger chunk of the profits because its margins are so incredibly high. And the insight here is it's not just some mature cash cow coasting along.
Its moat is widening.
Its moat seems to be widening, becoming more embedded as the global standard every year. That implies immense durable pricing power. So the contrarian thought is, even if ESG disappoints, even if that growth engine sputters,
The core index business is so strong, it provides a huge foundation.
a massive bedrock of value, a high-return, cash-generating machine that could keep compounding quietly for decades, providing a valuation floor the market might be missing while it obsesses over the newer, maybe riskier growth story. The old engine might be powerful enough on its own.
That's a really interesting perspective. Shifts the focus back to that core durability. Okay, let's synthesize this. Pulling it all together from the sources.
Yeah.
The bull case versus the bear case. Why own it? Why be cautious?
Right, the bull case, the main arguments for owning MSCI based on the material.
Lay it on me.
1, irreplaceable infrastructure, essential toll road, 90% recurring revenue, super stable and visible. 2, fortress moat, formidable widening defenses brand, data, high switching costs, network effects, proven by 93% retention.
Okay, essential protected.
3, financial juggernaut, superior numbers, 50% operating margins, 30% ROIC, elite cash conversion, profitable, efficient. 4, proven aligned stewardship, Long-term CEO, owner mindset, great capital allocation track record, those value-adding buybacks.
Okay, strong case. Now, the bear case, the counter thesis, the risks.
Main reasons for caution highlighted are 1. Demanding valuation. Premium price, 30x PFCF. Little room for error if growth slows. 2. ESG and climate risk. Key growth engine faces credibility issues. Potential regulation threats. Could impact growth and margins.
Valuation and ESG risk. What else?
3. Geopolitical target. Being the standard setter makes it vulnerable to political pressure, like that U.S.-China example. Threatens neutrality. Brand. 4. Key client concentration. Significant revenue chunk from a few big players, like BlackRock, over 10%. Creates some relationship risk.
Got it. Bull versus bear laid out clearly. Now, final stress test. The red team challenge. What's the absolute strongest argument for why buying MSCI today could be a mistake? The worst case plausible scenario.
The sources sketch out this scenario they call a double barrel failure. How it could really go wrong long term.
Double barrel failure? Sounds ominous. What happens?
It needs two big things to go wrong. Maybe together, maybe sequentially. First barrel. The ESG business collapses. All that skepticism proves right. Lawsuits hit, regulations bite, ESG ratings get commoditized. That high growth, high margin engine basically becomes low growth, low margin compliance work.
Ouch. Okay, ESG disappoints badly. What's the second barrel?
At the same time, maybe the big passive investing trend finally matures, slows right down, especially in developed markets. And crucially, maybe the big asset managers get fed up with paying MSCI and the other index providers so much.
And they back something new.
They back a new initiative, maybe open source, maybe nonprofit, something credible, much cheaper, designed specifically to slowly chip away at MSCI's core index moat over many, many years.
A slow erosion of the core business.
Exactly. So what's the outcome? Growth slows dramatically, maybe even stalls. The market, which happily paid a 30x plus PFCF growth stock multiple,
Re-rates it downwards. Sharply.
down to maybe a 15-20x multiple like a mature data company.
And if you bought today at 37x PE or 31x PFCF,
You could be looking at a lost decade. Flat returns, maybe even negative, even if the company itself stays okay. The mistake, as the sources frame it, wasn't buying a bad company.
but paying a growth stock price for what ultimately becomes a value stock future.
Precisely. That scenario really crystallizes the risk embedded in the current valuation.
It really does. Forces you to weigh that possibility. Okay, so wrapping this up based on everything in the material you provided, MSCI is clearly a phenomenal business. High quality, powerful moat that seems to be widening, great financials, strong leadership track record.
Absolute. Top tier quality.
BUT, it trades at a demanding price. And it faces these significant, maybe low probability, but high impact long-term risks, the geopolitical angle, the ESG credibility challenge.
That's the core tension, isn't it?
Yeah.
Amazing quality versus the price and those specific tail risks.
And hopefully this deep dive, built entirely from the sources you shared, gives you that full picture, the strengths, the weaknesses, the key debates. It's that shortcut to being really informed on the company.
Exactly. Having this comprehensive view, the business dynamics, the moat strength, the financials, those risks, the valuation context, that's what you need to form your own judgment.
So here's a final thought just to chew on, drawing directly from the perspectives in these sources. If the market is potentially underestimating the sheer durability and pricing power of that core index business, like that contrarian view suggested, how does that change the math on paying today's premium? And ultimately, how do you weigh the risk, however small, of that double barrel disruption scenario against the near certainty of owning an incredibly durable, deeply embedded, cash gushing core business?